Hello, I am here to unveil this newfangled project here at the McNeil International Studios, and it's a device that makes you fall asleep under any circumstances, and it is called Econ. And here to explain is Professor Mark McNeil from Irvine Valley College. Thank you, Professor. Thank you for taking your time.
The mad scientist seems to have been eating some grow pills lately. All right, this is about foreign exchange markets. You will recall that one of the four sectors, households, firms, government, and the foreign sector. It's one of the sectors. And in the circular flow, when income comes to households, most of it goes to consumption spending, but some of it leaks out in the form of savings, some of it leaks out in the form of taxes, and then a third leakage is the payment by U.S. people on U.S. imports. And this money goes to the foreign exchange markets. Now, what does foreign exchange mean? Is it the market in which foreign exchange? No, it's not. Is it the rate at which one currency exchanges for another? No, that's foreign exchange rate. It is not Helga who comes here from West Germany to study for a year. That's a foreign exchange student. I know I've used that joke before. Foreign exchange is the currencies themselves that are used to make trades between countries. So I'm going to simplify this a little bit, and I'm going to assume that there are only two countries in the world. There's the U.S. that uses the dollar, and then there is some other country, and they use the SOC, which stands for some other currency. So we're going to figure out here what determines the exchange rate between the dollar and the SOC. Now, they keep track of exchange rates between the US dollar and the euro, between the US dollar and the British pound, the Swiss franc, the Japanese yen, all of these. But they also keep track of what they call a trade-weighted index. And this is an index of the value of the dollar against all the other currencies the US dollar is used to exchange for, but weighted according to how important that currency is in the overall trade with the United States. Okay, what determines the value of the dollar against the SOC? And the answer is very simple. What else? Supply and demand. It's the supply and the demand for dollars in the foreign exchange markets. So you have a market with a downward sloping demand curve and an upward sloping supply curve. And what's being traded here is dollars. And the way you buy a dollar is with a SOC. In this case, the price of a dollar is 3 SOCs. 3 SOCs per dollar. If the exchange rate is 6 to the dollar, well, first let me explain. You always have to be clear that you're on the dollar side. This is the dollar market where dollars are exchanged 3 to the dollar for SOCs. So the orientation matters in this case. And second, what determines the supply of dollars in this market, and what determines the demand for dollars in this market? The supply of dollars in this market depends on U.S. people who want to buy SOC, goods, services, or assets. And here's why. If I want to buy a SOC-made car, say a Mercedes SLS, well, I have to take my dollars, and those dollars have to be exchanged for a SOC so that the SOC people will get the money so they can send me the car. They accept SOCs, I have dollars. So there has to be an exchange made where I sell my dollars in the foreign exchange market. That's why U.S. people who want to buy SOC goods, services, or assets are on the supply side of this market. When somebody from Germany wants to come to Disneyland, they have to buy the dollars. They have to buy the dollars in the foreign exchange market, and that's why SOC people who want to buy U.S. goods, services, or assets are on the demand side. Well, if they can get, if it costs them 6 SOCs for $1 worth of U.S. goods, that's a very high price to the SOC people, and they won't want to buy much. at that rate, and so the quantity of dollars they will demand will be small. But if they can get $1 for one sock, then American goods are extremely cheap to them, and they would like to buy a lot of dollars at that rate. Conversely, if an American only gets if $1 costs one sock, that makes sock goods very expensive to Americans. If, however, they're getting 6 socks for a single dollar, they would be very, very happy to buy sell lots of dollars in exchange for socks and buy lots of sock goods, services, or assets. So that's what causes a movement. A change in the exchange rate will cause a movement along the supply or the demand curve. But what causes a shift? That is a change in the supply or dollars. A supply or demand for dollars. And the answer is, if something besides the exchange rate changes that causes more Americans to want sock things, that would cause a change in the supply. Now, if the supply were to increase because more Americans want to buy sock goods, services, or assets, then that means the exchange rate would fall to 2.5 per dollar, 2.5 socks per dollar here. And when the exchange rate falls like that, it causes the dollar to depreciate and the sock to appreciate. All right. So if the supply of dollars increases, the exchange rate will fall to 2.5 here, and the sock would appreciate, and the dollar would depreciate. When the dollar depreciates, that means that it takes more dollars to buy sock goods, services, or assets. So sock goods are more expensive to Americans. If the demand for dollars goes up, that is if sock people want to buy more U.S. goods, services, or assets, then the exchange rate would go up, and in that case the dollar would appreciate and the sock would depreciate. So we will recall, please, that net exports is equal to exports minus imports. Net exports is a term in the aggregate demand: consumption, investment, government, and net exports. So if the dollar appreciates, that means that sock goods are less expensive to Americans, and American goods are more expensive to sock people. And as a result, since sock goods are more expensive, U.S. imports would increase. If exports were 10 and imports were 10 before, after the dollar appreciates, Americans import more. So imports would go from 10 to 15. And because U.S. goods are more expensive to sock people, exports would decrease from 10 to 5, say, and net exports previously was 0, and now it has decreased to -10. Well, when net exports decreases, since it's a term in aggregate demand, it causes aggregate demand to decrease, that is, to shift to the left. If the dollar depreciates, then that means that sock goods are more expensive to the U.S. people, so we will import less. So if we were importing 10 before, we're now only importing 5. But American goods to sock people are now cheaper when the dollar depreciates, and they'll buy more American goods. So U.S. exports would increase from 10 to 15, and this term of net exports would increase from 0 to 10. And if the U.S. dollar depreciates, and this is the only thing that happens, this is all ceteris paribus in a world where everything is happening constantly, we're assuming that this is the only big change. And if that happens, where the dollar depreciates, then with net exports rising, then that would shift aggregate demand to the right. Good job. Let's see. So we've already done this. It's just a review. If the supply of dollars increases and the dollar depreciates, then net exports will go up, and that would shift aggregate demand to the right, causing a little upward pressure on prices and increase in real quantity. This is one of the accusations about competitive devaluations, that if a country is able, oftentimes they believe, that if a country is able to devalue or depreciate their currency against other currencies, that will cause an increase in net exports and cause the country's aggregate demand to shift right, and it's sometimes used as an attempt to stimulate the economy. Okay, what if interest rates rise relative to rates in SOC? That is, U.S. interest rates are higher, and the yields on our bonds or other investments is higher than in SOC. Well, if that's the case, SOC people are going to want to buy more U.S. goods, services, or assets, and that's going to cause the demand for dollars to rise. And Americans are going to want to buy fewer SOC assets. They'll keep their money home and invest in this country. So the supply of dollars in the foreign exchange markets will decrease, and that causes the U.S. dollar to appreciate. And when the dollar appreciates, our net exports goes down and aggregate demand shifts left. So, anyway, this is an attempt to describe what the foreign exchange markets are, what is supply, what is demand in the foreign exchange market, what determines the exchange rate, and then what effect the exchange rate has on net exports and on aggregate demand. I think I've covered the ground.